Hi, everyone. This is Jason Burack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. I'm a big fan of his work. Actually, I think he started learning from me back in 2012, 2013, after he retired. He's a successful entrepreneur, a real estate investor, one of the largest and fastest growing global macro and investing channels on YouTube now, with over 300,000 subscribers, over 35 million views on his first channel, George Gammon. His second channel, Rebel Capitalist, is also rapidly growing and almost over 100,000 subscribers as well. George Gammon, thank you for joining me again.
Jason, thanks for having me back, my friend. And yes, I did start listening to your podcast way back in 2012. It was hugely instrumental in shaping my worldview and kind of building the foundation for what I know today in global macro and basically the YouTube channel. So I owe you a big thanks to begin here, because who knows, I might not be where I am today without your incredible podcast.
And the central banks over that time period, almost a decade or around a decade now, the amount of power. So they blame capitalism, they blame free markets, and then governments and central banks just consolidate more power over that time period.
Jason, listen, every problem we have is a result of a result of capitalism, corporate greed, and Putin. Didn't you know that? So obviously I'm joking there, but I think, we live in fascinating times. I say on my YouTube channel all the time, and whenever I do like a keynote presentation, I always use that Lenin quote where he says decades go by where nothing happens, and then there's weeks that go by when decades happen. And I think that's the time we're living in right now, especially from a standpoint of global macro, where there's just weeks that go by where we're seeing decades just flash right in front of our decades worth of changes occurring pretty much in real time. I mean, the CPI came out today at 9.1%. The expectations were 8.8%. And on the news, you saw gold actually go down. And I saw prior to us recording, the 10-year treasury is down, like 2.913, something like that percent. And it's actually down on the day. I mean, who would have ever guessed that at a 9.1% CPI, the 10-year treasury would be trading down to 2.9%, while the 1 year, by the way, is at like 3.21. There's like a 30 basis point delta between the 1 year and the 10-year. That's just absolutely mind-boggling to me. And while you have the DXY hovering around 108, something like that. I mean, when I started my YouTube channel, one of the things that I tried to get through to people, one of the things I tried to help people understand is you can't just assume that because we have consumer price inflation in the United States, that means the dollar is weak. People associate those things as though they're one and the same, right? So if we have 9.1% inflation, well, that means the dollar is weak. Well, it is compared to goods and services domestically, but it doesn't necessarily mean that it is relative to other fiat currencies. And now I think people are starting to see that, and to an extreme, right? Because we've got inflation at 9.1 and the DXY at 108. So what I mean by that is the domestic dollar is getting smoked. It's getting crushed as far as its purchasing power, where the international dollar is skyrocketing higher. And that just plays into everything else that everything else that's going on in the world right now with the Ukraine and Russia and the energy problems and Europe. And I mean, I just got done talking to our buddy Ronnie Stufferle, and he was talking about how in Austria, the government is coming out and saying that this is going to be a tough winter, and we're going to have to make some serious choices here. And that's assuming that Putin doesn't decide to turn off the flow of nat gas, which Ronnie said about 80% of the nat gas coming into Austria comes from Russia. So assuming that he continues to leave the taps on, they're still going to deal with shortages and having to restrict the use. I mean, we're talking about cold showers. We're talking about all of these things in a developed first world country. And this is just, all these things were unimaginable, even call it 6 months, a year ago. And I mean, I could go on and on and on. I mean, the uprisings in Sri Lanka, as an example, Argentina, Turkey, going through a hyperinflation. There's just so much going on, and it's frightening, but fascinating at the same time.
Yeah, just bad energy policies, this ESG, bad energy policies in the European Union, tons of bad energy policies. We could probably spend hours talking about all the bad energy policies in the Western world.
And it goes back, especially in Germany. I use this example in one of my presentations that I've given at a couple conferences lately, where they had a guy come in named Gerhard Schroeder. And this was a guy that became a politician, I believe, in the late 80s. And he was part of, I'm not sure what party he was affiliated with, but he kind of joined forces with the Green Party. And then he got elected to whatever, chancellor, president, whatever they call it, I believe in the late 90s. And one of the first things he did is go after nuclear. Say, oh, bad, 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 bad. And obviously he's just pandering to his constituents. So at the time, the amount of electricity generated from nuclear was extremely high in Germany, and the amount of electricity from nat gas was very low. And then in about 2002, 2003, he initiates, with Putin, by the way, the Nord Stream pipeline. He says, okay, we're going to get rid of this filthy, horrible nuclear energy, and we're going to replace it with nat gas and be completely dependent upon Russia. And this was a guy that was pandering to the Green Party, ironically enough. And it just goes to show you that the politicians, they don't care about climate change. They don't care about the temperature. They don't care about clean air. They simply care about maintaining or gaining more power, control, wealth. That's all there is to it. And this is a perfect example. And then, of course, when he gets out of office, I think Gazprom hires him on to their board of directors. And then Rosneft hired him on as well. And, and I think he even set up a second pipeline going from Europe into Russia at the expense of nuclear, which if they would have been in the same position today as they were back in the late 90s, they wouldn't have had this issue at all because they wouldn't be so reliant on nat gas. They would have had those nuclear power plants generating the electricity they need.
And the European Union is scrambling now to get liquefied natural gas deals from Qatar and other OPEC countries. Well, that's taking away, I just saw an article on it a couple of days ago from oilprice.com. They're taking away all the natural gas and liquefied natural gas imports from emerging markets. So there's not enough supply, and you have countries fighting over it. And then you're going to have rationing. And then that's leading, and you brought up Sri Lanka. You have all these different stress factors, cross currents that are creating problems. Emerging markets in particular, they look like they're collapsing first. So you have protests now, and it's in at least half a dozen countries, probably more than that, in just the last couple weeks. So like Albania, Bulgaria, Ecuador, Macedonia, Sri Lanka, and there's a bunch of other ones in Africa, Latin America, Eastern Europe, and Asia because of high food and energy prices, and then also with that dollar rally.
Yeah, and then what are the politicians doing? Look at the Dutch farmers. While we're dealing with these food shortages and spiking prices and all the stuff that you need, the politicians probably coming down from Klaus, honestly, but they're saying, oh, well, let's just wipe out 40% of the farmers because, we don't need that food. It'll just somehow get to us from the food ferry, as though there's no connection whatsoever to the supply of food and the actual price. Well, it's absolutely just stunning how stupid these politicians are, or maybe, I don't want to get too
they need someone to blame. They need someone to blame, right?
Well, it's either they need someone to blame or there's something bigger going on behind the scenes where they're just puppets of some of these crazies, some of these global elite that are trying to condition the population to use far less energy and to maybe purchase some of that land at a much cheaper price. That's something that I never thought of until I was listening to Tom Wood's podcast last night, which is one of my favorites. And he had a gentleman that was a journalist that has been boots on the ground with what's going on with these Danish farmers there. And he said that the farmers, one of their main concerns in what they think is going on behind the scenes is they're trying, the government, the global elite, are trying to completely wipe them out to where they have to sell all of their farmland. And who are they going to sell it to? The Bill Gates types that are going to come in and buy it at 20 cents on the dollar or something like that. And that's the view of the or the general consensus with these Dutch farmers, which is fascinating because I never even thought through it at that angle. It goes back to you'll own nothing and you'll be happy. Well, maybe this is the way, or one of the ways they're trying to make sure that we own nothing.
Well, Biden's also blaming gasoline station owners who hardly make any profit. A lot of them break even on each gallon of gasoline sold.
A lot of it's a loss leader, Jason. Yeah. A lot of it, they sell gas at a loss just to get you in the store so you can buy soda.
Or a car wash, yeah.
Yeah.
Yeah, so they're blaming the oil refiners. They're blaming the gasoline station owners. Biden's blaming farmers for supply chain problems and higher food prices. I mean, I just went to a restaurant over the weekend. The menu prices are up substantially 20, 30% just in the last couple months. So they're still raising prices at the restaurant with the CPI price. We're recording this on Wednesday, July 13th, 2022 for our listeners out there who want the date and time.
Yeah. And then let's not even talk about the Strategic Petroleum Reserve.
Oh my God! They're selling.
Do I even dare bring that up?
Well, there's so many felonies where people should be charged and arrested. Literally, DC now is the district of criminals. So you have to be a white collar criminal. You have to have a law degree, and it's just rape and pillage here. I don't know a nicer way to say it. The waste, fraud, corruption, and abuse here from white collar criminals, people with law degrees. The amount of raping and pillaging, it's very similar, George, if you study history, to the very end of the Roman Empire.
Yeah. And you would know this better than I would, but isn't a lot of that oil that's coming out of the SPR going to China?
Some of it. Now,
okay.
they were moving it to the European Union, too. So they were actually selling not just oil, but gasoline and diesel too. So there were the people who had the shortages here for diesel and the higher diesel prices. The Americans should get pissed because there's Reuters articles, there's oilprice.com. These are regular journalists that are not on either political party, even though there's Breitbart articles that are covering this as well. But there's regular centrist or mainstream media journalists that are covering this. It's just not being talked about in a lot of the regular media circles. So they have been exporting a lot of this oil instead of making sure America has it. The oil is going to have to get bought back, George, and it's going to be at a higher price. And then there's supply side problems. The politicians are not allowing the supply side problems to be fixed.
Yeah. And, I talked to Eric Townsend about this, and he made a great point. He said that even if you were to increase production in the United States, that might not solve the problem, because I guess the type of crude that we produce here is very, very light, and they actually have to mix it with like some sort of a different type of crude that they have to import in order for it to be usable. Have you heard anything like that?
So it depends on the oil refinery. Some of the oil refineries in the Gulf of Mexico area, they actually made enormous investments about 8 to 10 years ago for heavy sour crude. So they actually switched over so it was easier for Canadian oil sands and Venezuelan heavy sour crude. And that thicker oil, it's cheaper and it's actually more energy dense. So you can make a lot more different crude oil products, diesel, petroleum products like plastics and other things from it. So the light sweet crude is easier, I think, for liquid fuels, but the other products, it's actually harder. So natural gas is easier to make some of these other products. The average person doesn't understand this. There's actually all these different types of crude oil. So like you see an oil price like Brent crude and West Texas Intermediate. There's all these other different types of crude.
Yeah, got it. And then we haven't even talked about the dollar. I mean, and I think that's probably the biggest problem that's facing the global economy right now, for sure. I just did a whiteboard video on this the other day, and boy, oh boy, people really don't understand why the dollar is such a problem. The dollar goes up, so what? Who cares? So Colombia's currency goes from 4,000 to 1 to 4,500 to 1. Who, so what? So the next time they come to the United States, they can't buy as many t-shirts. But they don't they don't understand that it's a lot like the GFC. And this is the example I used in the whiteboard video to try to paint an easier picture for people to get their head around. And that during the GFC, we all know how it works. Basically, you got a guy that wants to buy a house. Let's say it's a rental property. He thinks prices are going to the moon and real estate prices never come down. So he takes out an adjustable rate mortgage. And let's say he buys the house and it's got $100 worth of positive cash flow after he pays the mortgage and the expenses. Everything's fine, dandy. Let's say he took out that adjustable rate at, let's call it 2%. And then what happens is the rates adjust to, let's just say 5%. And so now his monthly mortgage payment goes up by, let's say, $200. So now instead of being cash flow positive, he's cash flow negative. And he has to take the dollars off of his balance sheet to basically cover that gap that he has every single month between his expenses and his rental income. And that's even if he's got a renter. Who knows? He might not even have a renter in that situation. So everyone understands how that works and how that led to really, really big problems. It's the exact same thing, but instead of the average Joe buying a rental property, we're talking about entire countries. And we're talking about massive global corporations that have the exact same problem. And if we think about the GFC, we know that, okay, we had all these mortgages, subprime we'll call them, and this is kind of this base layer of debt that this inverted pyramid of derivatives was built upon. And let's just say that base layer of debt, just to throw out a number, was $5 trillion. Well, think about this. Are we to assume that those same derivatives haven't been built on global dollar-denominated debt that was created for corporations or for sovereign? Of course, you've got the same derivatives. You've got, it's, probably whatever it is, credit default swaps or CLOs or CDOs, you name the acronym or the abbreviation. So the difference there is instead of the base layer of debt that this inverted pyramid of derivatives is built on, instead of it being 5 trillion, now we're talking about 200 trillion. So if we had a quadrillion worth of derivatives with a base layer of 5 trillion, what size or what is the amount of derivatives that is being built on 20 trillion worth of debt? And I'm not saying it goes up at the same rate, but that's a big, big problem that no one's really talking about. And that's kind of the more esoteric problem. The main problem is what we were talking about with the GFC and the adjustable rate mortgage, where basically all of these corporations and sovereigns that have dollar-denominated debt, when the dollar goes up relative to their local currency, that's basically an adjustable rate mortgage. But instead of adjusting once every 2 years, it's adjusting every single day. So if you could have your debt burden go up by 20% within the matter of a month. So then what do you have to do? Well, you have to take the pesos, let's say, off your balance sheet to sell them, to buy the dollars you need to satisfy those dollar monthly payments, your mortgage payment, if you will. And that just creates more supply of pesos and more demand for dollars, which just exacerbates the problem. And then let's just say that same corporation is selling widgets to other countries and they're settling in dollars. So at least they have some dollar cash flow coming into their balance sheet. Well, if the dollar going up and up and up and up creates all of these problems for these global corporations and countries, then we see the global economy grinding down. And we see it coming, no, I'm not going to say coming to a halt, but the global economic output decreases significantly. So that means the velocity of those dollars decreases significantly. So then when you have this first problem and the first setup, you have a secondary problem when even if they are or were receiving dollar cash flows, the amount of dollar cash flow that they have to service that debt goes down as well, while at the same time, in this case, the peso cash flow goes down because their country is experiencing a recession because of all of the other knock-on effects from the dollar going up and up and up throughout these other countries where that are basically their customers. It goes back to that saying that Dalio has. He says one man's income is another man's, or one man's spending is another man's income. Right. But one country's spending is another country's income. And so that's, again, lower velocity of dollars. It just makes that adjustable rate mortgage more and more and more of a burden. And the only solution they have, which is basically taking pesos and buying dollars, just exacerbates the problem.
So back in 2019, I remember talking about this. And when we did our first interviews, you interviewed me first on your channel, I think in early 2020. And I was saying how the global economy, emerging markets, and China were already slowing down way before the pandemic, 6 to 8 months before. And a lot of the same problems that are happening now were happening back then. So you had the Chinese economy that was slowing down a lot in 2019. China is having enormous amounts of problems right now. There's videos of bank runs at the 4 major Chinese state-owned
lockdowns, for heaven's sakes.
So that's going to slow commodities demand. That's going to slow China's ability to export goods in their supply chain. You have the U.S. consumer. They're strapped out. So even though the dollar is rallying internationally, the U.S. consumer is dealing with enormous amounts of stagflation, high food and energy prices, taxes potentially going up on a lot of different things. And the emerging markets, George, when the dollar rallies and an emerging market currency gets weak, and then you add in the food and energy crisis on top of that, you have a situation. I'll just use Brazil since I know the numbers. Yeah. You have a situation where if you're making a minimum wage salary in Brazil, 25% of your monthly salary is going towards gasoline and diesel. So that means you're very sensitive to price increases in food for your staple crops, meat, and then for energy, just for you to go to work or to run your little small business.
Yeah, it's weird. It's almost like you have to look at the CPI. We'll just use that in the United States because that's what most people are familiar with, in 2 separate buckets. You've got to look at it. On one side, you've got the stuff we need. Food, energy, shelter. On the other side, you've got the stuff we don't need. Call it clothing from Macy's and electronics. So I think we could move into this world, especially over the next 6 months, where we get like a bifurcated inflation, where the stuff we need is going up and the stuff we don't need is coming down because the average Joe and average Jane, they have to rob Peter to pay Paul. Right? Because if you have to make a choice.
So they work for the government?
But if you have to make a choice of buying that t-shirt from Macy's or putting gas in your car, you're going to choose to put gas in your car. So that's going to be less purchasing power that you have for that other stuff, which goes back to what we were saying. If the American consumer has less purchasing power, that potentially means that we're importing fewer goods, exporting fewer dollars, which is less dollar cash flow, less dollar velocity, which means the dollar internationally has even more upward pressure.
Well, and historically, so I understand that argument, but historically, the Fed to stop this, because for listeners out there who are not familiar, according to the Bank of International Settlements, there's at least $13 trillion of dollar-denominated debt outside the United States. That's not counting the euro-dollar market. I think that's separate.
Way more than that. Way more than that.
So the Bank of International Settlements, their official number is over 13 trillion. What people don't understand, though, is these other countries, these foreign governments, these foreign corporations, they play currency games. So when the dollar got weak in 2021, and you had like David Hunter and Peter Schiff, when the dollar index, I think, got down to 89-ish, they were all predicting that the dollar was going to get very weak. But you had all these foreign governments and foreign corporations borrow more dollars. So in 2021, you saw a near record amount of dollar-denominated debt added to the pile. So these things are like a cycle, George. So when
because future dollar-denominated demand.
Well, yeah, you need even more dollars.
Because if you issue more dollar-denominated debt, all that means is that's just future dollar-denominated demand to service the debt.
Exactly. So it's a cycle then, but. Yep. Back to my point, though, about how historically, since 2008, 2009, I think the Fed and U.S. Treasury do understand this. They can't step in all the time, although I have found a lot of evidence that the European Union and the European Central Bank is basically a zombie. It totally collapsed in 2008, 2009, and they've been getting many trillions in currency swap lines for European banks since then. But since 2008, 2009, and in 2020, historically, the US Treasury and the Fed, when the dollar does rally and potentially threatens to collapse everything, so threatens to collapse foreign governments, foreign central banks, large foreign corporations, just a wide scale collapse, like this full deflationary scenario everyone's predicting, the Fed and Treasury just start issuing currency swap line guarantees to all these foreign central banks. And then historically, what they've done is they just waive the loans. So they give these countries the dollars they need, say it's an emergency, and then, 6, 12, 18 months later, the loans just get waived and these countries don't have to pay these loans back.
Yeah, so it's like a shadow Plaza Accord 2.0 type thing.
Hidden bailouts. And this is the central banks just have too much power because the Fed is picking winners and losers. So the Fed is saying that if this country plays ball with U.S. foreign policy, or this country plays ball with U.S. foreign trade, let's say this in exchange for those currency swap lines, this country has to agree to sell more food to the U.S. at a discount, or more oil or natural gas or something along those lines, some type of preferential trade agreement to get those dollars, so the government and the large corporations in that country do not collapse. So I think Nomi Prince actually wrote a book on this, I think like 4 or 5 years ago. So she was a managing director at Goldman Sachs and Bear Stearns. Yeah. And she flew to Brazil and she interviewed Brazilian central bankers, and she flew to Mexico and interviewed central bankers in Mexico. And she asked them about like bailout negotiations for currency swap lines, how the negotiations with Ben Bernanke in 2008, 2009. More dollars.
Yeah, I hear, but I don't think that's a panacea. And here is why. Even for the country that is getting the swap line. So if you think about the way a swap line works, sure, the central bank, or let's just say the banks in general in that country, have access to the dollars they need. Okay, got it. But in order for those dollars to get outside of the banking system to pay down the dollar-denominated debt with the corporations, those banks have to lend those dollars out. And the banks aren't going to lend those dollars out if they think they're not going to be paid back. So it's still, even if they've got, a quadrillion dollars, if they don't think they're going to get paid back, they're not going to lend it out unless there's some sort of, government guarantee, or if the Fed says that those banks themselves don't have to pay it back, or something weird going on like that. If it's just free market forces, just because they have the dollars doesn't mean they get out to satisfy the dollar debt. Now, that said, I think if you've got the let's say peso cash flow coming in for that corporation, at least those corporations can go to the banks and say, hey, listen, we have all these pesos, just swap them out for dollars, so at least we can pay our debts. And that could alleviate a lot of that pressure. But I don't think that's a panacea either, because that's dependent upon those cash flows, even in peso terms, staying very, very high, so they can actually make the swap. And so if we've got this global recession, then you would assume that you've got a peso recession, and I'm just using Colombia as an example, or Argentina. So if you have your peso cash flow deteriorating, you might not even have the pesos to go to the bank and make the swap for dollars to pay down the debt. So at a macro level, I see how that's definitely a potential solution, but if you really get into the nuance, I don't know that solves the problem entirely.
I agree. It doesn't solve the bottom-up issue. So it doesn't solve the people's issues on the ground there in these emerging market countries with their bills going up for food, energy, their local.
Nor the corporations that have the dollar-denominated debt.
So I think if the corporation is large enough and they have large enough loans with a large bank in the country, I think they will be spared. So I think like these Fed currency swap lines are really just meant to consolidate power further and screw over small businesses in these other countries and screw over the average person. So they only keep the government, in a lot of cases, it's a puppet that the US or China picks out, unfortunately.
It goes back to our original discussion, Cantelon effect. Boom.
Yes. So it just gets the rich richer. It maintains this status quo. It allows them to get more power. Oh, and then they could blame capitalism, even though central banking.
Putin, don't forget Putin.
Yeah. Well, I mean, Putin's not doing colonialism like the U.S. with the economic hitmen and what China has done in emerging markets in Africa and Latin America with debt diplomacy to get access to natural resources, though.
I think you're selling the media short, Jason. I think they could easily spin it to imply that or explicitly state that.
Well, that's just economic. That's just propaganda, though. That's not the reality. I mean, the reality is more like what. I'm joking. Yeah, the reality is more like what's in the economic hitman book and jingoism and debt diplomacy that the U.S. and China, European colonialism. It started there, and then the U.S. copied that. Now China's copying that.
Yeah, one of my biggest concerns right now that I was thinking through on a live stream yesterday, I think I might do a whiteboard on it tomorrow, is if we go to a Plaza Accord 2.0, like explicitly, not just with swap lines, then, if they overshoot especially, and then there's confidence lost in the dollar, where do we go next? And I'm very concerned that the answer would be the IMF, because they have an infinite balance sheet, and we would like to assume that it would be gold or something, or at least a currency backed by gold. But I think the central planners would argue that that's going to put us back into the same position, because you don't have the elasticity of the currency units that you would need to satisfy global demand. So the only entity that is going to be able to solve that problem long term is an entity with an infinite balance sheet. Again, insert the SDR and the IMF. That's my big concern, thinking through if we get a Plaza Accord 2.0, that further down the line, that will be the net result.
Well, none of the people in power, George, want physical gold and silver. Now, privately with their own money, Warren Buffett and these other hardcore Democrats and ESG guys, Stanley Druckenmiller, others, they're buying oil and natural gas investments. So they're buying inflation hedges. They own real estate. Bill Gates bought a ton of farmland. He owns a ton of land and farmland. They're buying real estate, farmland, oil and natural gas investments. Even David Einhorn, who's a traditional value investor, he never would have bought mining stocks or oil and gas companies. He's been buying those lately. So what they do at the government level is very different than their personal investments with inflation hedges and making sure that they're diversified with real assets and inflation hedges. So I don't think that they want a gold and silver standard. I don't think any government, not even China, who's been accumulating a lot of physical gold tonnage, and Russia, I don't think they want a gold standard.
No, I agree. That's why I'm concerned they're going to push us toward the IMF and the one global central bank with an infinite balance sheet, so we never have to worry about liquidity again. I think that's their pitch.
Well, the central bank digital currencies, even if they don't go to this one world government, this unified government system, it's still dangerous at a nation state level with central bank digital currencies, because then they just copy the China model with the social credit score. So they add that in, the social credit score. So if you make the wrong tweet or you send the wrong posting online, I mean, in China, they monitor direct messages.
Or if you interview George Gammon.
or if you say anything like #end the Fed, or you're a Ron Paul supporter. Yeah, you do any of those things, you're automatically in the system, automatically getting social credit score dockings with enough penalties. Then in China, they shut down travel. So they can ban you from getting on a plane, getting on a train. They could basically make it so you can't do any business or get hired for a job in China. So I think the Davos, I call them the Davos crowd, like the World Economic Forum people, the nefarious Bond villains like Klaus, Bill Gates, those guys. I call them the Davos crowd. So the Davos crowd, I think they really like the China model because it just limits free speech. It adds more control. It gives government more power. And then they could just bail out their friends with the Cantelon effect. And then guess what? They just blame it on capitalism. So they can afford like $10 a gallon gasoline or diesel. They can afford like $100 steaks that the average person can't afford. Their standard of living is destroyed with currency devaluation, taxes, and supply side commodities problems. That's not a big deal to them. Also, like their private jets and their yachts, they have exemptions. So they either buy carbon credits or they don't have to pay any carbon tax.
Yeah. That's why I always say that just don't let them fool you. When the global elite or the Davos types, like you're saying, when they talk about the importance of climate change and weaning ourselves off of fossil fuels, and they don't care about that. Now, that may be an issue that's important to you. I'm not saying that's not an important issue, but they don't care about that. That's just simply a Trojan horse. That's just simply a narrative to allow them to usurp power, control, and wealth.
Well, also Goldman Sachs then gets to be a market maker and create a whole new market. So they create a new carbon cap and trade market exchange, and then Goldman Sachs gets to collect, and these other Wall Street investment banks then get to collect large fees then on every single transaction. So
look at BlackRock. Look at BlackRock. They have all these ESG funds, and if you look into the ESG funds, they're charging much higher fees. So of course BlackRock is going to be all about ESG, because that's just funneling these noobs and these do-gooders into funds where they're having to pay an extra, call it 1 or 2% per annum.
So I want to ask you about deflation. So you're talking about your thesis then is the dollar is going to continue to rally, even if the Fed issues currency swap lines, starts giving out dollar loans that might not be able to stop this dollar rally. I think it will. The Fed basically...
No, I'm not making a prediction.
Oh, okay.
I'm saying that if the dollar continues to go higher, the problems that we're seeing are going to become much, much worse. That's not to say that I believe, that's my base case, that the dollar is going higher. I think I would give it 60-40. I would lean on the side of the dollar going higher, up to, call it 118. I don't think it'll hit resistance until it gets to that level. And I think these problems are just going to get worse. But what's just bizarre about that dynamic is you can have the CPI going even higher in the United States as the dollar is going higher and higher as well. I think that's what's hard for people to get their head around. I think the only prediction I've made lately is I think going into Q3, Q4, we'll probably get some disinflation here in the United States. So I'm not saying that, now this is aside from asset prices. I'm just specifically talking about consumer prices as measured by the CPI or the CPI, better said.
Changing propaganda index, either one, yeah.
Yeah, there you go. Yeah, exactly. But I think that the CPI will trend down, let's say, maybe Q3 or Q4, just because of aggregate demand being crushed by asset prices coming down. And then I think it's all about the central planner's response to that. And I think that will probably take us to the next wave of consumer price inflation here in the United States. So I'm not saying outright deflation. I'm just saying maybe the CPI goes from, whatever it is at the time, let's say 10%, down to 9, down to 8, maybe 7.5. And then at this time we're in a recession. And then the central planners, the Jerome Powells, the Janet Yellens, the Bidens come out and say, "Oh, look, we don't worry about inflation anymore. We told you it's transitory, and we told you the Fed was going to act just like Paul Volcker, and we see how the inflation is trending down. We've gone from 10%, now we're all the way down to 7.5, and the next stop we're going to get right back down to 2%, which is our inflation target. And you've got nothing to worry about. Vote for me." And while they're in a recession, they may use that as cover to just a trending down CPI to do more stimmies, to do, a CBDC, to take rates back down to zero, do more QE, the same playbook that we've seen for the past, 20 years. They're just going to roll that out. And then again, that takes us to the next wave. I think that's probably my base case, but there are no certainties. There are only probabilities.
And to add to your points there about how they could get the CPI down, commodities prices in the last, 3-4 months, especially industrial metals, fertilizer costs, they have crashed. Now, we're going to be looking at new normals here. If you look at the financial statements for the quarterly reports for a lot of these miners and agricultural companies, oil and gas, their costs are up a lot. So at some point, those costs are going to be passed on to the customer. They're already getting passed on to the customer. We're already seeing price increases in the supply chain and small businesses, at restaurants. The consumer price index is not covering this accurately, I would argue, especially with the price increases and the stagflation and shrinkflation that I'm seeing. But if commodity prices do stay low for, say, another couple months, that will reduce the tailwinds for a lot of these government economic data statistics that they're covering. But long term, we still have a lot of supply side commodity issues. But about deflation, that's an important point there about interest rates and the dollar. If the U.S. federal government, in terms of the national debt growth, it's still growing. The national debt's way over 30 trillion. The U.S. federal government, I don't think, basic math, George, I don't think it can afford 4% or 5% interest rates. So there can't be a Paul Volcker out there.
Yeah, I agree, but I think there's, again, nuance there, because assuming the government issues more short-term debt, and they do have to, most of their debt is short-term. I think Groman pegs it at like 10 or 11 trillion per year that they have to roll over. And you're right, rolling that over at 5% compared to whatever 1 or 2%, that's a big difference. But I don't know that breaks anything, because as of right now, the market seems to be absorbing it, because the Fed hasn't really, they're not buying 120 billion. And as of this month, they may be allowing things to roll off their balance sheet. So they're not as big of a player, if any player at all right now. So, with these auctions that we see, that's being absorbed by the market. And the long end is definitely being absorbed by the market when you see the 10-year trading at 2.9% with the CPI at 9.1. So I get it, but I don't know at what point the market would say enough. We are not going to buy at this interest rate or this yield, and we need prices to go down, therefore yields to go up, to where it would be a significant problem. Because again, right now it seems like the market's absorbing anything that Janet Yellen wants to sell.
So in the short term, maybe you're going to be right. But if the Fed keeps hiking interest rates, we're already seeing signs of U.S. home prices, real estate starting to crack. So real estate, and this is your expertise, is very sensitive to interest rates. People are very sensitive, especially if they didn't lock in a 30-year long-term fixed rate mortgage. So the more the Fed does hike, even if they're able to play games with short-term U.S. Treasury debt, where they don't have to pay a long-term interest rate of 4 or 5% on the national debt, they're able to roll over at shorter rates, perhaps. Real estate, if the Fed does keep raising interest rates, they're going to crack real estate, and then they're going to crash real estate, not just crack. I mean, real estate's already cracking now. I'm hearing just crazy stories. But if then
you got the tax receipt problem. I mean, you've highlighted this beautifully so many times. Yeah.
Well, this is a problem with a democratic style of government. When government is already too big, you have all these social program guarantees, you have all these government employee salaries, politician salaries. I mean, AOC and these other politicians here in Congress are making around $174,000 a year, and that's not even counting all the side deals and other goodies they get. You have all these other government bureaucrats and all these other government agencies that are getting guaranteed salary increases every year. So the longer they stay on, the higher their salary goes, and then they really can't be fired. So all of these in a democratic style of government, George, when tax receipts collapse, I mean, they don't cut. I very seriously doubt we're going to see 30, 40, 50% of the government workforce just fired.
Yeah, I think they can just increase the deficits. They can, we'll just call it quote unquote, print the money. But it's at what point does the bond market wave the white flag? And I don't know that we are there yet. Would they have to issue another? Would the budget deficit have to go up to 20% of GDP, 25%? I don't know what that number is, but it seems like we've got some wiggle room from where it is right now.
Well, in my opinion, I think the Fed is already buying a lot of these U.S. Treasuries. So you said there's plenty of demand for whatever Janet Yellen, the bullshit that Janet Yellen and Jerome Powell are saying, I think the Fed is buying these U.S. Treasuries, and I think the Fed is sticking them off balance sheet. So
yeah,
I think
so that could be something that we're not seeing. Yeah, and just to be clear to your audience, when I say that the market is buying anything Janet Yellen is selling, I'm just talking about the treasuries she's issuing at auction, just to be clear there.
And she's super rich now. I think her and her husband are worth over $10 million now. And all of her predictions the last 15, 20 years have been wrong since she started working at the San Francisco Federal Reserve Bank and said there wouldn't be a housing crisis. She was writing research papers saying there wouldn't be a housing crisis in 2006, 7, 8.
Who said the paint dry? Who said that QT would be like watching paint dry? Was that Yellen or Powell?
I can't remember.
Yeah, one of them. Anyway, yeah.
I mean, there's
another good call.
Well, a lot of these Federal Reserve Bank governors are all trading on inside information. They're buying municipal bonds. One of them was buying mortgage-backed securities that the Fed was going to buy. So they were buying them at a discount. They knew the Fed was going to pay 100 cents on the dollar for. I think it was the Kansas City Federal Reserve Bank president was buying them. This just came out in the last week.
Oh, yeah. Great arbitrage. Yeah, we need to start the fund, the Nancy Pelosi fund. We'll both be billionaires, Burack.
Well, she's probably the best money manager right now, but of course she's trading on inside information.
Exactly, that's what I'm saying. Exactly.
Because here in the District of Criminals, if you're a politician and a felon, you don't go to prison.
In fact, I think a fantastic hedge fund would be just go long anything Nancy Pelosi does and go short anything Jim Cramer says. What do you think about that hedge fund?
I'm wondering if someone's already doing it. I'm sure there's already people listening to the show that are doing it. There's popular Twitter handles like Inverse Jim Cramer. I think the guy's doing very, very well.
There you go.
So George, I have a couple more questions here on real estate and commodities.
Yeah.
Are we going to have like a 2008, 2009 style crash then in real estate then if the Fed keeps hiking rates? Are we going to have a big giant bust, or do you think the Fed will reverse course because they're going to see the problem? It wasn't that long ago that we had this housing bust, and then you were buying these properties. That's when you started investing, right? After you retired, you were buying a lot of these discounted properties. Were you bidding with BlackRock and the hedge funds then that were getting these interest-free loans from the Fed?
Not the big guys in 2012 when I first started buying and keep in mind that auctions I was going to were just the tax auctions in Kansas City on the Missouri side. So the county would foreclose on the individual for not paying their property taxes, and they would literally auction the houses off on the courthouse steps. And this would happen once a year in August. So August 2012, I was there. And the first time I went, Jason, I mean, my goodness, the real estate was persona non grata. I mean, that was public enemy number one. Everyone knew that if you bought real estate in 2012, you were going to go broke. So the amount of guys I was bidding against that first auction was maybe 10, 15, something like that. And to put that into context, I went back in, what was it, maybe 2016, 2017, just for kind of fun, just to check it out, because I happened to be in Kansas City during that time. And there was probably 400 bidders. So that's a good tell. When there's only 10 people that are bidding against you, when usually it's, at the top of bull market, it's 400. That's a good time to definitely buy. But my point is there were a couple kind of like hedge fund guys there, kind of like, or guys that were buyers for private equity, but not the big BlackRocks and stuff like that.
Well, I think from 2008 to 2012, 2013, I mean, just to try to get real estate prices back up, and sentiment was so negative from a lot of regular investors, the Fed had to give out free capital, low interest loans, or or basically 0% interest rate loans to BlackRock, to private equity, to hedge funds, to get them to start buying entire streets of houses in Nevada, Las Vegas area, Arizona. So it took years for the Fed to kind of figure out all these different schemes to try to get real estate prices back up. But then they fueled an even larger real estate bubble. And now it looks like if they continue to raise interest rates, do you think that bubble then is going to totally burst again?
Yeah. So this is where it gets really interesting. And I'm glad you brought up the Fed dropping rates and rates being very low for the BlackRocks of the world, I think it's a fallacy to assume that low interest rates means easy money or loose money. Low interest rates means cheap money, but it isn't necessarily easy. It's only easy for the BlackRocks, for the insiders, going back to the Cantelon effect.
Yep.
For the rest, for hedge funds. For the rest of the individuals like me, money was very, very tight, in fact. So the lower interest rates were not indicative of loose money, but tight money. And a good example that I'll give you a story is that first day I went to that tax auction, I ended up buying about 6 houses. And I kept buying after that, going into 2013, to where I amassed a pretty decent real estate portfolio there, quite a few houses. And I paid for all of them in cash. And then I would fix them and then put a renter in there. So I had this huge portfolio of all these single family homes that have been remodeled, that are awesome, in great neighborhoods, great school districts, not in the ghetto. These are A, B neighborhoods. Plus, they all have renters in them. And let's just say this is 2013. I forgot the exact time frame, about 2013. I go to the bank and just try to get a line of credit against all the equity that I have in these houses. And keep in mind, I bought them all cash. I own them outright. I own 100% of this entire portfolio. And I would go and try to get a line of credit just for like a 40% LTV. And the banks wouldn't even look at it.
Wow.
Wouldn't even look at it. So my point there, again, is that money was cheap, but it was extremely tight. And now, why does that matter? Because I think going into the next cycle here, if we fast forward into 2023, a lot of real estate investors think that, okay, I get it. We're going to go into a recession. The Fed's going to raise till they break something. Say they take Fed funds up to, 2.53. Then they're going to go right back down to 0. So I'm going to wait to go ahead and buy real estate and then just load up and borrow all this money when the interest rates are a lot lower. That may happen, but it may not happen because of what happened to me back in 2012, 2013. Money could be very cheap, but it could be incredibly tight.
So they're picking...
Go ahead.
To understand this more simply, they're picking winners and losers. So they're saying, George, even though you're a respected business owner, you've bought and sold businesses, you own assets.
Respected might be a stretch there, Jason.
well, you have a track record of buying and selling businesses. You don't have a bunch of failures, but you're not Mr. Big Shot hedge fund manager. You're not Mr. Retired corporate Fortune 500 senior executive there who retired with $30 million in stock options, or you weren't on business TV all this time. So they're picking winners and losers. And this is an important part of the Cantelon effect that's described here, because everyone's not getting access to this cheap capital there.
Right.
So people see that the Fed kept 0 interest rate policy. Well, if you're a small business owner here in the United States, you didn't get access to that cheap capital. You had to put your whole house and other things as collateral on a loan at a bank here, at a bank branch, just to get a small business loan. So you didn't get access to the 0 interest rate policy for the Federal Reserve Bank. That was for large banks, portfolio managers at banks, hedge funds, family offices. And this is a problem that the large banks saw all this cheap capital, and they started coming up with all these crazy derivatives and all these leveraged trades on currencies, bonds, stocks, derivatives, real estate, all these different things.
You got it. You got it. And it just represents what Milton Friedman was saying way back in the 1960s, even I think late 60s, is that low interest rates doesn't necessarily mean loose and easy money. In fact, most often it represents an environment of tight money, and higher interest rates represent an environment of looser money and lending standards. Although I will say that by the Fed taking rates artificially low, although the environment is tight money, the money is looser or less tight than it otherwise would be.
Unfortunately, we go back to governments and central banks again, picking winners and losers. So last question, George, before we wrap things up here, it's about commodities or cheap assets that you see right now. Maybe might not be the buying opportunity yet, but maybe 6 months from now, there might be really good buying opportunities. Do you think that commodities are still in a long-term bull market?
Yes, absolutely. Look at the cycles. I mean, the super cycles usually last 10 to 15 years. The last one that we went into, as far as I can tell, started in 98, topped out about 2011, 2012, and it's pretty consistent. And one of the main reasons why is just because it takes so long to bring on additional supply, as you know very, very well. So I think we kind of bottomed out in 2020 when oil got to negative $38 a barrel. When the price of the commodity is negative, I think that's a pretty safe bet that that's the bottom. And call me crazy.
Or all the producers are losing. Another good sign is all the producers are either bankrupt or there's wide scale bankruptcy or they've cut supply. So those are all signs that the bottom is either in or close.
Yeah. So I think that was kind of the start of this commodity super cycle that I think we're most likely in right now. Again, no certainties, only probabilities. So this takes us to 2030, 2035. So I see this as an opportunity for those who have that long-term backdrop to buy strategically. So what I mean by that is don't just blindly go out there and say, oh, I don't care what the price is today. I'm just going to buy it regardless. Or, if it's overbought, oh, who cares? I'm just going to go in and buy it. Now, I think you just use that long-term framework to build a position based on when things get cheap, when things are in panic mode, and or when the commodity gets below the cost of production. Those are kind of my three rules, and I need to give all the credit where credit is due there. The first two, Jim Rogers. The third, I got from Rick Rule, just kind of thinking through this stuff out loud. So that's what I'm doing with things like copper, with nickel, with coal, which is one of my favorites, with gold, not really so much because it's more of an insurance policy for me. Uranium, definitely. And so I'm just waiting for those prices to either get cheap historically when you adjust for inflation, or some panic selling, or when they get under the cost of production. I noticed this morning, and not that you would want to go out and buy the GD, is it XJ? Is that the ETF of the juniors? Yeah. But I noticed that the price there is at the same level as it was in March of 2020, when, if you think back to that time, the world was basically coming to an end. So I'm not saying go out and buy the ETF. I'm saying, subscribe to Jason's Patreon page, because he'll tell you all that you need to know about picking the correct stocks within the junior mining space. But that's when I see prices getting that low, then I start to get really interested and look at my watch list and say, I wonder if I should maybe pull the trigger here. Uranium is another one that, I think could be getting cheap right now. And let's see, what else was coming down the other day? Iron ore was another one. And I like iron ore quite a bit because some of the producers that throw off good dividends, especially in their dividend, what I noticed, I think I was looking at Rio Tinto. You can probably correct me on this if I'm wrong, but it seems as though their dividend really is dependent upon the price of the commodity itself. So in the case of iron ore, you see their dividend kind of track the price. So if you believe that iron ore is cheap because of, let's say, what's happening with a global recession, China, et cetera, then you could buy that stock at a very low PE and then assume that if the price goes up, they're going to increase their dividend as well. And you kind of get a double whammy there. So these are the types of opportunities that I'm looking at for my own portfolio. Now, as a crazy kind of juxtaposition, what I'm doing with my dry powder is I'm actually keeping a lot of it in T-bills, in 1-year T-bills, because my strategy there is if the commodity prices get low or super cheap again to where I want to buy them for the next leg up, we're most likely in a recession. And in that environment, the Fed is most likely lowering rates. which means I'll get a little bit of a capital gain on the 1 year. And worst case scenario, if they don't get cheap and interest rates continue to go higher, that means we're probably not in a recession yet. And I'll just go ahead and wait it out and collect the 3% and get the principal back. It's better than having cash where you're not getting that 3%, but you still got kind of the dry powder there. So those are the things that I'm doing in my own personal portfolio. Hopefully people find some value there.
And you're seeing big name investors like Warren Buffett, Stanley Druckenmiller, David Einhorn, and a lot of these guys, they're either hardcore Democrats or they're ESG people, or they're traditional value investors, and they would never buy mining stocks in the past. They would never buy oil pipeline companies in the past. They would never buy oil and natural gas producers in the past. And yet you're seeing disclosures from people like Stanley Druckenmiller. They're accumulating base metal miners and coal miners like Teck, which has a diversified portfolio of base metal and coal mining tech resources. And then you're seeing David Einhorn, and he's a traditional value investor. I didn't think I would ever see him buy oil and natural gas producers, oil pipeline companies, base metal miners, and he's disclosing that. And he's also disclosed that he expects a big run in the gold price starting in the next 6 to 9 months, I believe.
Yeah, buy low, sell high. Just do that, we'll all get rich.
Well, it comes
easier
down
said than done.
It comes down to central bank intervention and policies, and in government preventing investments in fixing the food and energy crisis. Because I would argue, George, that over the last 6 months, you've seen even worse policy that's going to prevent investments in fixing the food and energy crisis. And then on top
they're doing the opposite, Jason. They're doing the opposite of what you should do, because you've got to reduce demand, increase supply. And what they're doing is increasing demand and reducing supply by saying, okay, we're going to give you a windfall tax. We're going to disincentivize future capex or investment to increase the supply. And then what we're going to do is we're just going to give stimmy checks to like gas stimmies to everyone. So you just increase demand, reduce supply, which is only going to make the price go higher.
And you've also seen with this commodities price crash, you've seen a lot of potential new mines and large oil and natural gas projects. They've been postponed or delayed or canceled for at least like the next year or two, maybe even longer than that. So to bring on a large copper mine or a large base metal mine or a large oil and natural gas field, liquefied natural gas project, these things, the construction costs, the capital expenditures, these things could take 5 to 10 years, sometimes even longer than that. If it's a really large copper mine like the Oyu Tolgoi underground copper mine in Mongolia, these things can take a long time and billions of dollars of investment.
That's why the super cycles last 10 to 15 years and not a year or two.
Agreed. So I think there's a buying opportunity. I don't know if it's quite yet, but it's looking like there's going to be unbelievable bargains. I think with the low-cost producers, you're already seeing this now. We were discussing this before we started recording. The low-cost gold miners, the gold royalty companies that don't have the energy costs, the low-cost actual gold miners, oil and natural gas companies that still have free cash flow. You're starting to see mergers and acquisitions. So the companies themselves are looking at the things that we just discussed, and they're seeing, look, there's going to be supply problems. We need to replace the supply that we had from depletion. We see demand for our commodity, supply and demand. We see demand growing long-term, especially for natural gas or uranium or fertilizer, some of these other ones. And they're starting to do deals, mergers and acquisitions that maybe you have not seen in past cycles.
Yeah. I mean, I just couldn't be more bullish on commodities long-term. I mean, we could talk for another hour about, especially what the Davos types, you know, how everything that they're pushing is going to reduce supply, no more investment. I mean, it's, I think it's a easy setup, but the timing, as always, is a challenge on knowing when to buy and when to kind of just hold and wait for a better price.
Well, I think the mistake people made over the last 4 to 6 months is a lot of people were day trading. And so they were trading on margin and they were chasing the stock charts higher for these fertilizer companies seeing the food crisis. So they were seeing all these headlines about fertilizer exports being banned. And they assumed that the fertilizer companies would keep increasing prices. We've had a big correction now in the fertilizer price. These fertilizer stocks, I mean, they're still making good profits. The low-cost producers are. And if these stocks stay low, you're going to see mergers and acquisitions. A lot of these farmers, George, they did not go and buy the fertilizer. So they're actually like the crop yields and the amount of crops planted, like globally, we're looking at whether it was drought or either a drought or flooding in certain areas, or just high fertilizer prices because the farmers, their costs were too high and they didn't want to pay the extra capital. They're going to wait it out a year. They didn't go and buy the fertilizer. And yet the globe needs more food with the staple crop and the food shortages. So I think the food and energy problems, I've interviewed a bunch of different hedge fund managers since February. It's looking like one of them said even 10 years that the food and energy crisis could last.
Yeah, which again plays right into that time frame of a long-term super cycle.
Okay, well, I've kept you for over an hour, George. I really enjoyed our conversation today. Hopefully I'll be back on your show in the not too distant future. I think I might do
Absolutely, man. Yeah, we'd love to get you on Rebel Capitalist Pro too, and get in there and talk to some of our members. I'm sure they'd love to kind of pick your brain on everything we've talked about today, is commodities, miners, etc.
I look forward to that. So if my listeners want to follow your work, I'll put a link to your Twitter and your 2 YouTube channels. I want to thank you so much for your time today.
Yeah, thanks for having me on. I'm super excited about the YouTube channel, the George Gammon channel. It looks like we're actually going to hit 400,000 subscribers this Saturday. So I'm super stoked for that.
Are you throwing a party or something?
I actually am. Yeah, I'm having there's a real fancy place here in Medellin called Black Mamba. And it's, one of these kind of swanky joints like New York, where it's up on the 22nd floor and they've got really expensive whiskey and all that stuff. So I'm taking all the editors and all my staff, everyone who works on the YouTube channel, I'm taking them up there to celebrate on Saturday night.
Do they have steakhouses in Colombia similar to like Argentinian steakhouses or Brazilian steakhouse?
Oh, of course. There's one just right up the street that I always go to that not only has awesome steak, it's an Argentinian joint, but they also have live tango music. So they've got a tango band, professional tango dancers and singers performing while you are enjoying your steak and wine or whiskey or whatever you drink with your steak.
Well, congratulations. I know how hard you've been working. I think you've been working, 12-hour days to grow your YouTube channel. So just insane amount of work that you put in the last couple of years.
Thanks, buddy.